The performance in the first quarter was flat, and that compares to global equities up 4.5% for the first quarter. And since inception, the strategy has generated a cumulative return of 75%. And that translates into an annualized performance of roughly 19% versus the MSCI All Country World, which was up by 40%. Or 11% annualized over the same period. The biggest contributors in the quarter were Alphabet, ASML, Microsoft, Intel, and Cisco. And the biggest detractors were Tesla, Apple, Keyence, AMD, and Qualcomm. They all took a bit of a breather after a very strong 2020. The best performing sectors were 3D printing and space. That's not too surprising because they are associated with cyclical sectors typically. On the other hand, the worst performing sector for the quarter was new energy. While unusual suspects in terms of growth and innovation strategies in our portfolio are, for instance, Caterpillar and Deere. They performed very well in the first quarter given the cyclical uptick following the rise in bond yields and a better outlook on the economy. For instance, Caterpillar is a company that we find very interesting because it has continued to innovate over time in many areas that we cover, such as robotics, advanced materials, 3D printing, or drones. For instance, they have semi-autonomous mining trucks that improve efficiency and safety in mining operations, which we find fascinating. And on the other hand, John Deere have a lot of interesting technologies that they put to work, including sensors, or for instance, telematics, and also motion control and machine vision, which are used in their spraying machines and their seeding machines. So we are generally agnostic with respect to value and growth exposures. We explicitly screen global equities for exposure in applied innovation. This approach naturally gravitates somewhat towards a growthier exposure. However, we have a significant allocation also to value sectors and value stocks in the areas of, for example, 3D printing or advanced materials or space and new energy. From a long-term perspective, we think it makes a lot of sense to have exposure to structural winners in the market that can not only grow their business based on an expanding economy, but that are very innovative and that are able to create new markets or take market share from complacent incumbents. And so we think having this core exposure to innovation winners is just a sensible long-term strategy. Yeah, we're very excited about this new strategy that we call the Singularity Small and Mid. As the name would suggest, here we focus on a small and mid-cap universe, and we focus on the top 100 innovation leaders based on our investment methodology in this smaller cap space. It's a really nice complement to our existing offering with the Singularity Fund because it covers more the smaller cap universe, whereas our Singularity Fund gravitates more towards large cap names. So in a way, this portfolio is akin to an incubator portfolio where smaller cap names can graduate into larger cap names or interesting acquisition targets. What's more is that the portfolio characteristics of our small and mid portfolio are very interesting compared to your traditional small cap portfolio because it's highly profitable, it has strong revenue growth and much less burdened debt profiles. you.